Saying to everyone, good. Okay. Hello, class. Tonight we're going to be covering Chapter 13, which is distributions to shareholders, dividends, and repurchases. So quickly, we're just going to cover some of the learning objectives. First we're going to look at cash distributions and firm value and the effect. Say different dividend policies have on firm value. We'll look at the clientele effect and kind of some of the investors that you attract based on your policies. And then we're going to look at information and signaling and how the market interprets your dividend policies and interprets different changes in your policies as well. We're going to look at implications of dividend stability. We're also going to look at setting the target distribution level for the residual distribution model. And then we're going to move on. We're going to do one piece of practice for the residual distribution model as well. We're going to do some procedures, basically look at what steps you have to take when you want to initiate a cash distribution. And then we're going to compare dividend versus stock repurchase, well, issuing dividends versus repurchasing stocks, pros and cons, and then other factors. We'll summarize the chapter and we'll talk a little bit about stock splits as well and what reinvestment plans are. As is with the start of every single PowerPoint in this entire textbook, this is how you value a firm. And I'm sure everyone's a little sick of seeing this by now, but it's just the present value of all your free cash flows, discounted at the weighted average cost of capital. So into the content. Cash distributions and firm value. The distribution policy determines the level of cash distributions to shareholders. So they also form, it's a form of the distribution, so dividend versus stock repurchases. So a dividend is when you have the firm actually issue cash, right? And you'll get a certain amount of, say, cash per share. So if I earn, say, one RBC stock, maybe I'll get $1.50 for every single RBC stock that I own, right? So say I own 10 RBC stocks, I get $15, right? $1.50 times 10 stocks, right? Whereas sometimes we have the situation of a repurchase and we find that we end up getting the same amount in cash, but there are actually tax advantages to it. And then stability of the distributions as well, and kind of what the distribution method that we pick, the impact on the stock price, and also the preferences of our shareholders as well. So distribution versus payout ratio. A distribution ratio is the percentage of net income distributed to shareholders through cash dividends or stock repurchases. So payout ratio is the percentage of net income paid as a cash dividend. And the payout ratio must be less than the distribution. So distribution ratio is everything. It's dividends and stock repurchases. Whereas the payout ratio, when we say payout ratio, we're not referring to stock repurchases. We're only talking about dividends. That's the difference between the two. And then both ratios determine the mix of yield return versus gains return, or basically how much do we earn from cash distributions from the firm versus how much do we earn in capital gains, right? There's only two ways that you can earn income, usually on a stock, right? And very generic, but you can either earn dividends, right, in the form of dividends or share repurchase, or you can sell the shares and earn a capital gain. Sometimes a capital loss if investing isn't your thing. But dividend yields versus capital gains. A high distribution ratio and a high payout ratio mean large dividends and small or zero stock repurchases, right? Dividend yield is relatively high and expected capital gain is low. So again, how I said, you can either earn via capital gains or dividends. If your dividends are very, very high, there's a good chance that because the firm is paying out so much in net income, they're not retaining a whole lot in net income, right? So therefore, the business isn't retaining a lot of assets, and therefore the business isn't growing in value, okay? So if the business isn't growing in value, your shares aren't really going up in value because your shares are just one little portion of the valuation of the firm. So businesses where they pay out a whole bunch of net income, your stock price doesn't generally go up as much, and because of that, your capital gains aren't as big, right? So whereas a business that doesn't pay out a lot of their net income, they don't pay much in dividends, this usually is tech stocks that are basically in high growth scenarios. They retain all that net income as retained earnings so that they can reinvest it into operations. And because the company is going to grow, you'll see way more in capital gains, right? So it's the mix of whether you're going to receive high dividends and low capital gains, or high capital gains or low dividends. And then if both are low, then you have an underperforming stock. So a large distribution ratio but a small payout ratio means that you have low dividends but more repurchases. So it means that, yes, you have a lot of distribution of cash, but they're not paying much in dividends. So that means most of the distributions are occurring with share repurchases, which we'll go through. So optimal distribution policy. Lastly, a low distribution ratio, right? It means we're not paying out much in dividends, and we're not paying and we're not buying back much stock, right? So therefore, we're entirely going to be like basically capital gains, right? And the optimal distribution policy must strike a balance between cash dividends and capital gains to maximize the stock price. But we'll get into the clientele effect and how it impacts the preferences of our shareholders. So we have three theories of investor preferences for dividends. Dividends are irrelevant, right? And let's just remember, these are three separate theories, so they're going to contradict each other, okay? First theory, dividends are irrelevant and investors don't care about payout, okay? Second theory, bird in hand, investors prefer a high dividend payout, okay? So first theory, investors do not care whether you pay out the dividend or not. Second, investors have a preference towards high dividend payouts. And then the third, the tax preference. So investors prefer a low payout, hence they prefer a capital gain because capital gains are only taxed at 50%. Whereas dividends, if you ignore dividend tax credits, you basically have to bring them into income immediately, right? So in that case, investors prefer capital gains. So we're going to go through each of these theories individually. Dividend irrelevance theory. Investors are indifferent between dividends and retention generated capital gains, right? So whether the firm pays absolutely no dividends or they take their entire net income balance and they pay out their entire net income, right? And you would have a 100% distribution ratio if you did that. In that case, what we're saying here is that dividend policy basically has no effect on the firm's value or its cost of capital. At the end of the day, a firm is valued at its free cash flow, right? And whether you pay out your dividends or you don't pay out your dividends, your firm's gonna have the same free cash flow. So therefore, the underlying asset is gonna be worth the same, right? And therefore, the investor return is gonna be worth the same. So whether the investor earns that return through a dividend received or they earn that through a capital gain, it's gonna be the same return overall, right? So therefore, in theory, whether you pay them out a dividend or they receive that through a capital gain of selling the shares, the investor shouldn't care. And that's what this theory is saying. It does not matter whether you pay out dividends. It does not matter whether you hold them all in and then reinvest in your operations and grow the firm. The returns are going to be the same for the investors. Therefore, the investors should not care whether you pay out a dividend or don't pay out a dividend. And so the MMOs, they supported irrelevance. And the theory is based on unrealistic assumptions, so no taxes. And so if we remember back to chapter 12, the only reason we have like capital structure theory or anything of that sort is because of tax and tax benefits, right? Because we get a portion of our interest back, therefore debt is cheaper, right? And then it also decreases our cost of capital as well, right? So the only reason capital structure is relevant at all, and the only reason our weighted average cost of capital changes when we bring on debt is because of tax. If we didn't have tax, it wouldn't make a difference. It's the same thing here. If it was not for tax, investors would not care whether we pay out a dividend or whether we pay out a capital gain. But because of tax, because the investor can choose when they bring that income into their, personal tax return, because they can choose when they sell the stock, right? When you sell the stock, it triggers the capital gain, and then you have to report it on your tax return. Fun fact, you can hold a stock worth, say, $1,000 worth of stocks, okay? You can hold those stocks for the next 30 years. They earn a 12 or 15% return. It's all capital gain, and it's no dividends. You can hold that stock for 30 years. Over the 30 years, you won't pay a dime in tax. Nothing. Because unrealized gains are not taxed. You only pay capital gains when you sell those shares, and then you pay the difference between what you received and what you originally paid, right? But you only pay tax on half that capital gain because only 50% of capital gains are taxed. So it's an added bonus that you can defer your tax, and you only pay half the tax when you're in the situation of capital gains, versus when the company pays a dividend, you're screwed. You can't defer it. You have to bring it onto your tax return immediately for that year. It'll automatically go onto a tax slip, and then you have to claim it. If you're earning at the top marginal rate of 50%, you receive a $500 dividend, you're paying $250 in tax immediately, right? So all of a sudden, damn it, I have to pay tax, right? I only have $250 to invest. Whereas if it's a capital gain and I don't sell, I get the full $500, and then that's going to continue. I'm going to earn returns on that 500. I get the compound interest going on, and then that's usually how you turn something like $1,000 or $1,500 into $1 million over the course of 35 years, right? There's tax benefits here that we have to consider, and if it's unsheltered, generally speaking, capital gains are favored for tax purposes. Now we have birth in hand. Yes.
So,
Go ahead.
okay, so I got the context on the taxes on dividends, but not on the stocks. Like, what
Yes.
if we are selling those stocks after 30 years? Like, how does that work?
Yeah, of course. So here's the thing with capital gains, okay? As long as you hold it and you don't sell it, you don't pay any tax, okay? So when you have, on the day that, basically, right, say we originally buy the stocks for $1,000, we call this our adjusted cost base, okay? ACB is what we call it in tax. So this is basically the base, and it's what we originally paid for, okay? So any income that we have has to be over and above this $1,000, right? Because if it's under, if I sell it for like $900, well then I have a $100 loss. That's not income. I don't pay tax on that, right? But if I sell it for anything over like this $1,000, that's income, right? So here's the thing. This original investment of $1,000, right? I buy it when I'm, say, 20. I don't touch it until I'm 55, okay? This actually, at a rate of about 12 or 13%, can grow to $1 million. I kid you not. If you have it taxed, well, technically, you don't even have to have it tax sheltered if it's all capital gains, okay? So if they don't pay out any dividends, right? No dividends at all, and this just keeps growing, and it's all capital gains, and you never sell it, and you just let it grow, you don't pay any tax because you haven't sold anything, right? Say you're, I don't know, you're 45 and it's, at the time you're 45, it's worth $800,000. Yes, it is worth 800K, right? But, and you have a 799, this would be your unrealized capital gain, okay? The key is it's unrealized. So, until you sell it, you don't pay any tax, right? Because there's no income. You haven't earned anything, right? I can't take that money and do anything with it until I sell the investment. So it doesn't become income until I sell it. So eventually, right, when, I turn 55, it's worth $1 million, right? Well, this is a very bad eraser. But, it's basically worth $1 million. This would be my proceeds if I sold it at 55. Right? So say I sell everything I originally bought for $1,000 and I sell it for $1 million when I'm 55. My capital gain is going to be 999,000. 99. Okay, but here's the trick. This is your capital gain, okay? CG. This isn't your taxable capital gain, okay? You only pay tax on capital gains on half of it. So you get half the capital gain tax free, but you pay tax on their half of capital gain. So if we want to calculate our taxable capital gain, we take 50% of this, right? So half of $1 million is 500,000. So this would be 4,995, I believe. Yeah. Sorry, that is a 4. My 4s look like 9s usually. Okay, so this would be your taxable capital gain, okay? The 4,995, because this here is what you would actually pay tax on. So this would go onto your income tax return, this 4995, and then you would pay it on whatever your marginal rate is, say 40%, 30%, right? This other portion, the other half, the other 50%, tax-free. That's it. You don't pay any tax on it, right? So say your personal tax rate's, I don't know, 40%, right? So my personal tax rate, right, 40%. Okay, this is where I'm gonna stop eyeballing things and use a calculator because I don't want to embarrass myself because this is recorded. But I'll hop over to my calculator. I'll take 0.4 times 4, 99,500, right? So in this case, I would pay $199,800. And that's what I would pay in tax, okay? I made $999,000 and I only paid almost
Like
$200,000
around
in
200.
tax. Yeah, right? So if I take that and I divide it by my original capital gain of $999, the total like income that I actually earned, I really only pay the 20% tax return, or tax rate. On the entire thing, I only pay 20%, right? Which is half the 40, which makes sense because I only paid it on half, right? So my effective tax rate is really only 20%. Whereas, if, this grew and it ended up being $1 million, but it basically, I had to keep getting dividends and then I had to keep reinvesting, dividends, reinvesting. It probably would not end up being equal to $1 million, right? Because every time I get a dividend, I pay half the tax, right? It would probably end up only being equal half. It would probably end up being equal to like 500,000, right? And on top of that, right, say this finally grows to 500,000. This is basically capital gains. This is dividends, right? So in the same time period, this one ends up being equal to 500,000. And then I basically, so the total income that I earned over the period, right, would have probably been about 500,000 in dividends, and then the other half would have been capital gains, right? So the 500,000 that I earned in dividends over the entire life of these years, right? If I take, this is the capital gain that I would earn, right? But then this is the dividend portion over here, right? So if I look at the 500,000 that I made in dividends over the 30 years, I have to pay the full tax rate on this, right? So if my tax rate was 40% average over those years, I would pay this at 40%, right? And then, so 500,000 at 40%, it's gonna be very, very close to
Around
that.
20,000, right?
Let's see, 500,000 times 0.4. Oh,
20,000?
what's that?
Is it 20,000?
Yeah, I got 200,000. So
Oh,
200,000 is what I would pay in tax. So my after-tax proceeds would be $300,000, but this is only on the dividends, right? On this one, right, assuming that here's the thing is my ACB is gonna be a lot higher now, right? Because I kept basically buying, right, and then I had to sell. So basically I keep getting dividends, and then I'd have to add them back, and I get dividends, and I have to add them back, right? So this would likely be a lot higher, right? But in the end, we'd probably be equal to about, we'll keep it the same just for comparison purposes, right? Even though it's definitely not. And then say we do the math, right? So if we go to 1,000 just to isolate the capital gain, 499. And then basically you pay it on 50%. So 50% of the 499, 5 times 499. So 249. And then at 40% that. That should have been, yeah, that's right, 0.4. So 999. So in this case, if we take what we ended up paying on the capital gain here, right, the 999,800, and then we added on to the total tax that we paid over all of our dividends over the lifetime, we paid $399,800 in tax, basically, right? And we probably barely earned as much because we basically, we kept taking tax hits the entire way, whereas this one, we didn't pay any tax, and all of those earnings kept compounding tax-free until we eventually sold it. So under this one, you're going to pay more tax and you're probably going to earn less over the life of the asset. Whereas with the capital gains, when you eventually sell it, you're going to pay less tax, right? And you're not going to pay tax as you earn the income over the life of the asset. This is especially beneficial if you're going to be a retiree. So say you're earning at about a 50% tax rate, like throughout your career, right? And then 55 comes around and now you're pulling it for retirement savings. Your tax rate drops to 30%, right? So now, in this case, now we're using a low tax rate when we sell for the capital gain. We get to keep even more of it, but we only pay at half of it, right? So, long story short, this is why investors like capital gains. Because they can choose when they pay the tax, and in the long run, they pay way less tax, right? Whereas dividends, you have no choice. The second the dividend's paid that year, you have to bring into your income. If your personal tax rate's 50%, you're paying 50%, right? If you earn like if you have a good year and you get 30,000 dividends, sucks for you, you're paying 15,000 in tax, right? Whereas capital gains, right? Oh, I have an unrealized gain of 30 grand, perfect. I don't pay any tax. I choose when I pay a tax because it's whenever I sell it. So that was a crash course in personal tax and kind of the benefits. I'm not advising on how to avoid tax. I want to be very clear. I am a CPA, so I do not consult on tax avoidance. What I do consult on is tax deferral. And tax deferral is a strategy, and this is how you defer your tax, right? And in the long run, because you defer it, you pay less.
Yeah, I work part-time in BMO, so I see these things. I mean, like RRSP things and TFSA. That's why I was like kind of curious about it. Okay, what would be the tax on capital gains?
No, absolutely. So here's the thing, right? With TFSA, though, you don't have to worry about any of this, right? Because dividends, not quite true, actually. Dividends earned in a TFSA, if they're US dividends, there's a 15% withholding tax automatically applied. So you'll never even see it, but your dividend yield will be slightly lower than what it actually is, what's reported. So when it comes to US stocks that are held within a TFSA, you will pay a 15% withholding tax, but you're not going to pay any Canadian tax on it, which is very, very nice. And you're not going to see that withholding tax thing in the tax book, I just know, right? But when you go and you withdraw from the TFSA, you pay no Canadian tax, right? So technically speaking, even if it's paying dividends, you're not too worried about it. It's still going to grow. RRSPs, you don't pay the 15% withholding tax. There's a treaty between US and Canada, and it's not withheld when they pay out the dividend to you. But when you eventually pull that income of an RRSP, you do pay tax on it, right?
Yes, yeah.
Yeah, so in this case, you don't have to worry about any of this if you're dealing with a TFSA. You should know the little piece with the US dividends, and that's why capital gains are still better, right? But in the long run, this is way less amplified when you have a TFSA because it's technically all tax sheltered. And then same deal with the first-time home buyer savings plan. If you throw away $8,000 a year into that account and then you eventually pull it, right, to invest in a house, you'll pay no tax on it, which is very nice. And you'll get the tax back that you would have paid on that $8,000 during the year. You can actually bring down your marginal tax rate quite a bit if you know what you're doing. But take a personal tax course. I'm going to try to stick to finance. I've done a lot of tax in my life, and it's an area I'm quite interested in. But happy to discuss this anytime for sure. All right. Okay, so anyways, back to the bird in hand theory. I'm not sure I quite agree with it. This is more geared to retirees, okay? And this is very true. So investors think dividends are less risky than potential future capital gains, and that's true. Hence, investors like dividends. So if we think of any Canadian bank like RBC, TD, they've paid dividends the last 150 years, okay? Like literally, they haven't missed. Every single quarter of the last 150 years, these banks have paid dividends, okay? And they've actually, in total, earned pretty good returns, honestly. But because of this, and same thing with other insurance companies, same thing with Enbridge that pays about a 7% dividend yield, they're considered lower risk because you can almost guarantee that these companies are always going to pay out their dividends, because if they drop their dividend even a little, the stock price is going to tank, and management is terrified of that. So you're almost guaranteed that these companies are not going to cut their dividends, and it's going to be a nice, consistent cash flow. What's also nice is when a company pays a dividend, you get that money and it's yours, right? It's not in the stock market anymore. You can reinvest in the stock market, right? But unlike a company where you get a capital gain one year and you could just get a capital loss the next when it goes back down, that money is no longer at risk because they pay it out to you, bird in hand, right? It's the old saying, bird in hand is worth more than two in the bush. The bird in hand is basically the fact that you're getting a dividend today, whereas two in the bush would be the capital gain that you have not yet realized, okay? So the idea here is that they argued that the required return on a stock decreases the more dividends you pay out. Because your investors perceive that stock as lower risk, they require less return, which is nice. And then if so, investors would value high payout firms more highly, aka a high payout would result in a high stock price. So this theory specifically says that investors like dividends, and basically your stock price will increase the more dividends you pay out, and the required return will decrease. Again, this is just one theory, and it fits a very specific investor profile. Specifically, usually retirees, because retirees, they can handle massive fluctuations in their retirement savings. They need constant payouts to support their retirement, right? They're no longer going for aggressive growth. They're dialing it back at that point. Therefore, constant income makes a lot of sense for a retiree, right? Doesn't go down too much, doesn't go up too much, just nice steady income. Whereas if you're younger, you don't really want 5 to 6%. You want like 11 or 12, because the difference between 5 or 6% and 11 and 12% is 3 times the value in 30 years, right? So would you rather have 750,000, or would you rather have 750, 1.5, 2.25 million when you retire? Probably the 2.25 million, right? That's the difference between going mid-risk versus high risk in the long run. But you have to know how to diversify away your business risk so that you only have market risk. That's the trick. You need to have more than 40 stocks, which is easy if you're trading exchange traded funds.
And
Okay.
difference between the percentage is risk premium, if I'm not wrong, right?
Yes, and the risk premium is driven basically by that individual stock. Well, kind of. Here's the thing. Yes and no. Risk premium multiplied by beta is what drives it, right? So if you remember back to chapter, was it 8? Yes. So when we eliminate business risk, right, we no longer have any business risk. All we have is market risk, right? We have beta, and beta tells us, right, how much does this stock go up when the market goes up? So if I have a beta of 3, right, market goes up 1%, my stock goes up 3%, right? Because it's basically my coefficient of variation with the market, right? So when I'm no longer worried about my businesses going down, all I'm really worried about is market risk, because my portfolio is big enough that that's all I need to worry about, right? Basically, if you buy like 3 different exchange traded funds, you're probably indirectly holding 1,000 different businesses. If one of those businesses fails, you're not even going to notice it, to be honest with you, right? Because it'll get offset by another business doing great. You won't notice. So once you get rid of that business risk of a company going down, you're invested wide enough, your only risk is volatility. That's it, right? So we would define risk as basically, here's your required return. Say your required return's 10%, okay? Your risk, your market risk, is that your portfolio does not achieve 10%. It achieves somewhere less than 10%. It's not that you lose your money. That was business risk. We got rid of that, okay? Your risk is your volatility, right? But here's the thing. As volatility increases, return also increases. Because we define risk as volatility, when we increase our volatility, we increase our return. So when you're young, it does not matter if your portfolio does this, up and down and up and down and all over the place, right? Because the portfolio with high volatility might average a 30% return, right? You want an example? Look up SOXX. It's an ETF that's specifically focused on semiconductors. It has a standard deviation of almost 50%. It's huge, right? Because it's so volatile, right? But its returns are 30% on average per year. Whereas the stock market returns are only about 11 or 12. It almost triples the market return, the average market return. Why does it do this? Its beta is 3.6, right? So when the market goes up by 1%, this thing goes up by 3.6%, right? If you look at any of like the top performing ETFs that just have crazy returns, they're all leveraged, right? Stock market goes up by 1%, these things go up by 5%, right? So they're extremely volatile. But investors that don't care about volatility and are basically in it for the next 30 years, as long as you have enough diversification, you don't really have to worry about your volatility too much. You just have to not pay attention to it. You have to accept that some days your portfolios might be down 40%, right? But you have to just trust in your gut that over the, say, an average of 5 years, the average return on that portfolio will be around, say, maybe 12 to 15%, right? And that's what keeps you investing, because you know a 12 to 15% return, say over the course of, say, 30, 35 years is going to fetch you a couple mil when you retire. Versus someone who goes for, oh, I want a more balanced portfolio, I want bonds, right? Which, you know, they're at historically high yields recently, but historically you're not making $1 million on bonds, right? It's just the case because they're lower risk because they're just debt, right? Whereas equities generally are usually much higher at around the 11 to 12% average market return. So anyways, we've digressed massively into what the definition of true market risk is, right? And volatility, but very, very high level. When you have a high beta, it means you have a very, very volatile stock or ETF, right? But that's not necessarily always a bad thing, because if it's properly diversified and it's invested in enough different things, volatility is not going to hurt you if you don't sell. You only lose when you sell, right? And if you're diversified enough, companies may go down, but you're not going to notice because the average performance of your portfolio is still going to be high, right? As long as you're sufficiently invested. Okay, so now we're gonna step away from birth in hand, which is dividends, and we're going to go into where is it? Tax preference theory. Okay, so capital gains are preferred, as I showed you here, right? And it's specifically because you choose when you pay the tax, right? Say you're in the best years of your life, you're between 30 or say 45 and 55, you finally land your dream job, you start your business, whatever, and you're netting a whole bunch of money, but you're also paying a whole bunch of tax, right? Because that's what comes with earning a lot of the money, is you pay a lot of tax, right? You're not going to want to bring your investment income because you're going to lose half the investment income to tax. So you're going to invest in stuff that's mostly focused on capital gains because you don't have to sell it. So you're technically not going to pay tax on it, right? There's a whole bunch of debate at the political level of people that want to be able to tax unrealized gains because they know there's a whole bunch of millionaires and billionaires that have a whole bunch of stocks that they've been holding forever that they don't want to sell because they don't want to pay tax on it, right? And if you hold, say, this 1 million in shares, right, and you don't sell it, you can actually get a loan against the $1 million in shares. So say you get a $500,000 loan and you don't pay tax on that loan. This is what a lot of, like, you know, basically people that have a lot of the money, angel investors, do. When they want to raise capital, they don't sell their shares because they don't want to pay tax on it. That's like their wealth, right? So they don't touch it. They leave it be, and then they take out loans against those shares basically to finance their next investments so that they can basically get capital financing because of those shares without having to pay tax on it, right? So that's another way that generally the rich will avoid tax. Again, I am not advising on tax evasion. I'm just giving you an idea of kind of how the world works and how the tax system works. I didn't build the tax system. I just teach it. Okay, so third theory, investors prefer capital gains for very obvious reasons. All right, here are two graphs, okay? So just remember, each one of these theories it's tailored to an individual type of investor, okay? So each one of these theories has a different performance. So in the bird in hand theory, under this case, what happens is as we pay out more dividends, the stock price goes up because these investors see high dividends as basically a safe company, and therefore they value the company more highly the more dividends the company pays out. And therefore, because they perceive the company as safer of an investment, their cost of equity of the shares goes down. The required return goes down, right? Because the safer something is, the less risk. And because the risk is lower, therefore we require less return, right? But the second, right, our market beta goes up, and then we perceive a company as more risky, we require a higher return because of that riskiness, right? So in the case of the irrelevance, basically this theory says that it doesn't matter whether I do or don't pay dividends, right? It's not going to impact the valuation of the firm. So under this theory, as I increase from a 0% to 100% dividend payout, no impact. My stock price stays the same, and my cost to equity stays the exact same, because technically the underlying asset's still worth the same. I still get the same returns, right? But I am ignoring the implications of tax. And then lastly, the tax preference theory. So people that are not so worried about, how safe the stock is and, how consistently they pay dividends. People that don't really care about this and are, say, more focused on, basically the tax advantages, these people are going to say, hey, the more dividends you pay out, the less this is worth to me because, basically, I have to pay tax every time you pay out the dividend, right? So you're actually costing me money when you pay out dividends. So in this case, people that are aware of tax implications, a firm is worth less to them the more dividends they pay out, and they require a higher return the more dividends they pay out because they're saying, okay, if you would have just left this as capital gains, I would be worth more. But because you're forcing me to pay tax, I require a higher return from you to offset the tax you're forcing me to pay, right? So this is kind of just an example of all the different theories and whatnot, and how it impacts your cost to equity versus your stock price. So I believe next we get into the clientele effect. No, yeah, okay. So we talk a little bit about the evidence. So testing has not been perfect, just like it was with our stock market theories. It's really hard to understand. Number one, a company does X, the investors do Y. Well, it comes down to psychology. Why are investors doing what they do? We can never truly know why investors do what they do, right? They have a whole bunch of reasons. So when it comes to trying to interpret why investors do what they do, it's really hard. So therefore, coming up with evidence to actually support these theories is also really hard, right? So recent evidence suggests that firms with higher dividend payouts also have higher required returns, lending support to the tax effect hypothesis. It is also shown that in countries with poor investor protection, companies with high dividend payouts are more highly valued. So because of this, right, when it's poor investor protection, people are more worried about basically if they'll actually ever realize the capital gains because they're not as well protected by, say, the US is the SEC, which has a lot of teeth and really protects investors, right? So in that case, say in these countries, if you're investing, say US, Canada, you have a lot of trust in the SEC, right? And therefore you feel you're protected. Therefore you feel you can trust those future capital gains, right? Whereas if you don't have the same protections, right? Depending on the country you're in, you may feel that you can't trust those future capital gains and you actually prefer dividends because I want the cash now because I don't trust you later, right? And that's where it depends on investor protections, whether they prefer capital gains or dividends. And evidence shows that individual investors have strong preferences and prefer stable and predictable payouts as well. Yes, this is true, depending on the investor. Retirees, absolutely, right? Whereas people that are trying to maximize the returns for long run gains, right? Not so much. Stable, predictable payouts mean nothing. Payouts mean paying tax, right? So it depends. But there is some evidence to this. So this is what I'm kind of warming up to here. It's the clientele effect. So different groups of investors or clienteles prefer different dividend policies, okay? So a firm's past dividend policy determines its current clientele of investors. So for instance, RBC, Enbridge, right? Companies that have legendary dividend yields, okay? They're going to attract retirees, all right? Those retirees are specifically going to buy into those stocks and they're going to be happy doing it, right? Therefore, if RBC or Enbridge or any of those companies looked at who's investing in their stock, they're going to notice it's probably upper age individuals who have already retired, right? They've attracted that specific clientele, okay? That other ETF I told you about, SOX, it's a semiconductor ETF. It's invested in NVIDIA. It's invested in a whole bunch of different purely semiconductor manufacturers, okay? Those companies don't really pay dividends, right? Because they are high growth and they have strong balance sheets. Those companies are also highly volatile because they're in tech, right? They are not going to attract retirees. Retirees are not going to tolerate their investments going up and down and up and down. They're going to be sick, right? They're going to be like, I get no income this year and then I get $80,000 next year. Like, they're going to be broke, poor, broke, poor, broke, poor. They're not going to be very happy, right? So in this case, with the clientele effect, it's going to attract people that have steady income already and are basically looking to maximize their passive income, right? People that don't care what happens in the stock market, just don't lose my money, basically, right? Maximize my return. I'm invested across enough things. I'm not going to lose my money. I have no business risk. It's all market risk. I don't care what my volatility is. That's the kind of clientele that sort of ETF will basically attract, right? So based on your dividend policy, right, if you pay out a lot of dividends and they're steady, right, over time, you're probably going to attract people that that's what they require. They basically depend on their investments to live. Whereas if your dividend policy is to pay out very little in dividends, but you're purely capital gains, reinvesting high growth, you're going to attract people that want to be on that growth train because they want to earn long-term compound growth to grow their investments, right? Hence the clientele effect. You set your policy, you'll attract a specific group of investors. So information content or signaling hypotheses, investors view dividend changes as signals of management's view of the future. So managers hate to cut dividends, so they won't raise dividends unless they think a raise is sustainable, right? The second you raise dividends, you're running the risk that you cannot maintain that raise in the future. And if there comes a point where you raise dividends and then you keep going with that constant growth and then you suddenly have to cut them, everyone's going to freak out. Everyone's going to sell your stock. They're going to basically perceive management as incompetent because management raised their dividends and they didn't predict that they wouldn't be able to hold that raise, right? And then they cut it. So they're going to basically look at this. They're going to say, management is not properly planning. They basically raised their dividends and they couldn't sustain it, right? Therefore, I no longer trust management. People at the helm aren't paying attention. I want out. It's been shown a lot of companies really struggle to recover when they cut dividends, right? And it's specifically because of this signal that sends into the market. Therefore, a stock price increases, increase at the time a dividend increase could reflect higher expectations for future EPS, not a desire for dividends, right? So it's the same way the other way. Management increases dividends, shareholders might buy in to that company because management increasing dividends means management is confident in their future cash flows, right? They're buying into the confidence. They're not necessarily, they might not actually care about the dividends at all, to be honest with you. A higher dividend, right, might not mean anything to them. It might actually annoy them a little bit, right? But management's showing confidence because investors know management doesn't like to cut dividends. So if management increases dividends, the inherent assumption is the belief that management believes they can hold that level of dividends. Therefore, management has confidence in their future cash flows. Therefore, I can trust those future cash flows. This company is more stable. Therefore, I buy in, right? So it comes down to this. We increase dividends. Why are shareholders buying the stock? Is it because they want dividends or is it because we're more confident in the company? Who knows? We can't prove it. We can't go and we can't go to the millions of shareholders out there and say, hey, why'd you buy this stock? That's not how it works, right? So the data will always be incomplete, but we have to be aware of this, right? It doesn't mean keep cranking up your dividends. Your tax preference investors might get really annoyed and basically leave you and go to a company that just focuses on capital gains, right? But then you'll start attracting more retirees, right? So it'll offset, right? But again, the clientele effect will kick in. So here's the example though of when you cut your dividends. This is what you do to shareholder confidence, right? So this is Yamana Gold from April 2014 to May 2014 to April 2015. Things aren't going too well, right? The stock price starts going down. I'm assuming they're having issues with cash flow. And then management decides, hey, we're going to cut dividends. For the next 6 months, this thing never came back up. It never came back to what it was, right? Because shareholders basically said, you broke my trust. I expected you to keep dividends constant, and you didn't do it. You didn't plan for the future. I no longer trust you. Therefore, I'm selling your stock. And probably about half the shareholders sold off the stock and never came back. And the other half people never bought back in because they're like, I'm not sure about management here. So there's a big excess supply of stock in the market, right? So when people bid on the stock, it doesn't go up, right? So that's why the share price stays low. But yeah, so yeah, this is a prime example of what happens. Cut dividends and your shareholders might not trust you anymore. They probably also won't be your shareholders anymore. The ones that walk anyways. So there is clearly some information content in dividend announcements, right? Stock prices tend to fall when dividends are cut, even if they don't always rise when dividends are increased, right? However, it is difficult to tell whether any stock price changes following changes in dividends reflect only signaling effects or both the effects of dividend preferences as well. It's really hard to determine when I change my dividends. Is it really because the stockholders care about the dividends? Or is it really because they're reading in to my, basically, my forecast for the company, right? And they're reading into why I'm changing the dividends, right? So whether it's the stockholders that are trying to read my behavior and why I'm doing things, or whether they actually care about dividends, we don't know, right? But we do know it's a mixture of the two. Some are reading into my actions and trying to forecast the company, while others actually care about the dividends, and that's why they're buying in. But it is mixed. So implications of dividend stability. The clientele effect and information content hypothesis imply that investors prefer stable dividends. A stable policy means that regular cash dividends should grow at a steady, predictable rate, and reducing dividends to make funds available for capital investment could send incorrect signals to investors. Do we get into the example? No, we don't get into it yet. High level, when you have a mature company, what they do is they basically maximize their dividend payout because they don't have a lot of opportunity to invest, right? They have a lot of excess cash sitting around, right? Because they've matured. And basically, it's a mature industry, right? So it's not high growth. They don't have to reinvest a lot. So they have a whole lot of cash. So they basically pay out a whole bunch of dividends, right? That's what RBC does. That's what TD does. That's what really any kind of matured industry will do, okay? Whereas when it's a high growth industry and they have to finance that growth, they don't pay out much in dividends. They retain that net income and they reinvest it into their operations, right? So when it comes to a company that basically looks into the future and they say, hey, I have some really good opportunities on the table, right? I want to retain my net income to invest in those really good opportunities. They may cut their dividends, right? That's me as management making a decision to cut my dividends, not because I'm not confident in my future, but it's because I'm extremely confident in my future, right? And it's because I want to make investments, I want to grow. The problem is the investors don't know that. They don't have the internal information that I do. So the investors may look and say, hey, you cut your dividends, you're not confident in your future, you're not confident in your future cash flows, I'm out. Whereas the real reason I cut my dividends was because I needed that cash flow to invest in high return projects, right? So in that case, you're going to see a dip because investors will misread the situation. Then the company will start growing and profitability will start going up. They'll actually start to attract a different clientele. And then you're going to see the stock price go on a surge, right? As the company's growth starts to take off the net income. But the same investors likely won't come back. The investors that like the dividends are probably going to go on to some other, investment. Whereas the investors that like capital gains are going to now jump into your company because they want the growth. Okay, I'm doing a lot of talking, so I just need a quick drink of water here. So, setting the target distribution level, the residual distribution. Firms in profitable but mature industries such as utilities, financial services, tobacco as well, right? There's not a whole lot of growth in the tobacco industry. Typically distribute a large percentage of their cash to shareholders. They don't have a lot of profitable investments on the table. I'm sorry, but financial services, it's peaked a little bit, right? There's only so many ways you can open a bank account, right? It's not like it's a innovative high growth sector anymore, right? That's more in technology, right? AI, those kinds of sectors are high growth, right? Whereas these industries, specifically, utilities too. Again, yes, we are getting more innovative and clean ways to basically generate electricity for utilities, right? But high level, people are just constantly using the same utilities. So with these, they have a lot of cash flow, but not a lot of investment opportunity. Therefore, they pay out a lot of their cash flow. Firms in rapidly growing industries such as high tech tend to pay out lower dividends. So they're going to have different target distribution models. Here's an example. And you can look these up. These are publicly traded. TC Energy goes by TRP. That's the ticker if you want to look up the company. They're in the utility sector, and they pay out 68% of their net income. Okay, their dividend yield is 6.3%. National Bank, that's a Canadian bank, right? They pay out 49% of their net income every single year, and their dividend yield is 4%. That's relative to the stock price, right? Sun Life financial company, heavily into insurance, right? They pay out 54% of their net income, and you earn a dividend yield of 3.9%. Now let's go down to, say, an information technology company. Information technology company, Constellation Software, CSU, they only pay out 20% of their bottom line in dividends. They retain 80% of their net income to invest in their operations. Therefore, their dividend yield is absolutely minuscule, okay? Canada Goose, I actually did in my 4th year here at Algoma University for my strategies course, I did a case on Canada Goose, right? And believe me when I tell you, they are high growth. They are in Canada, they are in Europe, they're overseas, they're doing a whole bunch of initiatives, right? But that's just the area they're in. You might not think consumer discretionary is a high growth industry, but because of their niche, they are high growth. And therefore, because of the cost of their product and how much it actually takes to make their products, they have to retain all their net income to do it, right? They don't pay out a dime in dividends, nothing. You own a Canada Goose stock, you are not getting any dividends. It's pure capital gains. Cha-ching for tax purposes. That's awesome, right? So you're not going to get any dividends, but you're getting pure capital gains because they're just purely focusing on growing the company, right? Depends. If you're in a growth industry, you're not going to pay out dividends. But if you are in a matured industry, such as utilities or financials, you're going to pay out way more dividends because you don't really need to invest in anything, right? So you don't really need to keep the money. So factors determining the optimal distribution ratio. Investors' preferences for dividends versus capital gains are one of them. The firm's investment opportunities, the firm's target capital structure, and the availability and cost of external capital, right? So when we do the residual dividend model, which I'm about to introduce you to, it takes into account point 2, 3, and 4. It takes into account what your investment opportunities are, what the firm's target capital structure is, and the availability and cost of external capital, okay? You can't really take into account your investors' preferences for dividends versus capital gains, okay? Why? Because of the clientele effect. It doesn't matter, okay? You set the dividend distribution model that makes sense for your capital structure, and you're going to attract a specific type of investor, and those investors will buy your stock, right? Don't worry about the investors that aren't going to like your dividend distribution model. They'll leave and they'll go to a company that makes more sense for them, right? So you don't really have to take into account point 1. It doesn't actually matter. You'll attract the right people, right? You just have to be patient. But when we're saying our dividend target of what we're going to distribute per year, we have to account for point 2, point 3, and point 4. Because those points are within our company and within our control and drive our decision to pay dividends. So in comes the residual distribution model, okay? Find the reinvested earnings needed for the capital budget, right? So pay out any leftover earnings, the residual, as either dividends or stock repurchases. This policy minimizes the flotation equity signaling costs, right? Because we're not issuing equity, we're retaining enough retained earnings, we're retaining enough net income to finance our capital budget, okay? And because investment opportunities and earnings will surely vary from year to year, a strict residual dividend policy would lead to unstable distribution. So very high level, what we're looking at is Say we have a $10 million capital budget, okay? And that's on average. Every single year, we're going to have to basically invest $10 million in order to grow our business, okay? So let's say, I don't know, our capital structure is 50% equity and 50% debt, okay? That means every single year of that 10 million capital structure, or that 10 million portfolio of projects we want to invest in, if we're going to finance it 50% by equity, we have to pour $5 million of retained earnings into it every single year. Therefore, we'll retain $5 million in retained earnings, right, or net income every single year. What's left over is the residual. The residual gets paid as dividends. That is all the residual dividend model is, okay? So here's the formula for it. Your net income minus whatever your target equity ratio is. Your target equity ratio comes from your weighted average cost of capital, right? If we're financing 50% of our operations with equity, okay, we just literally take whatever we're going to invest in our capital budget, right, from year to year, multiply it by 50%, that's how much we need to finance with equity, okay? We take basically our net income minus what we need to finance with equity, what's left over gets paid out in dividends, okay? So it basically calculates what your distribution will be. You don't do this from year to year, okay? Usually you'll do, say, a 5-year capital budget, okay? And you'll say, okay, over these 5 years, on average, I'm going to invest $10 million per year into my operations, right? And I expect my net income on average to be this, right? So then you set your residual dividend model based on that 5-year average, okay? That way, your dividends are constant. Because we know the second we say, ooh, we need to retain more, net income, right? And we cut our dividends, our shares are going to go to hell. Because the investors are going to sell off, they're going to think we don't know what we're doing, right? And they're going to jump off. So we set this in the long term to make sure that in the long run, we're retaining a net income to finance our capital projects, and therefore we don't have to cut our dividends, okay? And that's kind of the whole idea with the dividend distribution model. It's saying a long run kind of target for what we're going to pay out. So for example, we have 3 forecasted capital budget levels, okay? We have 40 million, we have 70 million, we have 150 million, okay? The target capital structure is 40% debt and 60% equity, okay? And it needs to be maintained. So forecasted net income is going to be $60 million, regardless of if we invest $40 million in capital projects, $70 million in capital projects, or $150 million in capital projects. Our forecasted net income is always going to be 60 million, okay? So if all distributions are in the form of dividends, how much of the 60 million should we pay out as dividends under each scenario? So of the $40 million capital budget, and this is just to show you, we're doing the $40 million first, okay? So of the $40 million capital budget, right, 60% of that is going to be financed by equity. That's coming from here. Our capital structure is 40% debt, 60% equity. We take 60% of 40 million. Therefore, we need to retain $24 million in net income every single year to finance, 60% of our capital budget, okay? So every single year, we're going to retain $24 million in our firm to finance our capital budget. Therefore, what we have left over, right, is the $60 million net income minus the $24 million we retain. We have $36 million left over that we don't need for investments. Therefore, we take that $36 million and we pay it out to our shareholders, okay? So in the case, basically, of our total $40 million capital budget, we're going to finance $24 million, aka 60% with equity, and then we're going to issue, $16 million in debt at 40%, the other 40%, okay? And then we're going to pay out $36 million in dividends. Pretty easy, right? It's not complex. This is one of the few areas of finance you can sit back and you can honestly understand it in about a minute, right? And then our payout ratio, right, is just going to be the $36 million in dividends that we pay out divided by our total net income. This just means that we pay out 60% of our net income to our shareholders on a year-over-year basis, okay? We'll probably attract, at that level, we're kind of getting out of growth companies. We're getting into more mature companies. We're probably going to more attract retirees, people that prefer the bird in hand theory, right? That prefer those dividends, right? Whereas we probably won't won't attract the tax preference investors that are going for that long run growth. So here's all of them together, okay? Capital budget of 40 million, 70 million, and 150 million, okay? Again, under all three circumstances, our net income stays the same at $60 million, all right? But our required equity, it changes, because the required equity that we need to keep within the company is going to be 60% of our capital budget, okay? So in this case, we take 60% of 40 million to get 24 million. In this case, we take 60% of 70 million to get 42 million, right? And in this case, we take 60% of 150 million to get 90 million. This is the net income we need to retain in the company to basically maintain our capital structure, okay? The problem is, here we're good. We have 60 million in net income, right? Which is more than 24 million. Therefore, we have 36 million left over to pay those dividends. In this case, we're still good. We have 60 million net income, which is fine, because we only have 42 million that we need to retain in the company to finance our capital projects. We have 18 million left over, and therefore that's paid out in dividends, okay? This 18 million divided by the total 60 million, 30% dividend payout ratio, okay? Here's the problem. 60 million net income, we need 90 million in equity to finance our 150 million capital budget at a 60% equity structure, right? Therefore, we take that 60 million minus the 90 million required to be retained, we're at a $30 million deficit, okay? We don't pay out any dividends, right? Because there's nothing left. We retain the entire 60 million in the company, and we would have to issue an additional $30 million in equity onto the open market to raise enough equity to maintain our capital structure, okay? So this is how basically your residual dividend model would drive, say, what we expect to do over the next, say, 5 years, right? And it would set our target dividend payouts over the next 5 years. So investment opportunities, capital budget, and distribution. Fewer good investments lead to smaller capital budget and therefore a higher dividend payout. If you don't have much to invest in, you have a high residual, you pay it out in dividends. More good investments lead to a lower dividend payout, right? So if we have a huge capital budget, we have a lot of opportunity, we don't have a lot to pay out in dividends, right? So therefore our payout's going to be a lot lower. And then earnings should be retained only if a company can invest them in positive NPV projects. If you don't have good opportunities, you don't just leave cash in your company, right? There's a concept of when I used to work in tax. Specifically, we called it usually or basically capital stripping. But what you do is you don't want to leave cash in a company, because when cash just sits in a company, if you get sued, they have claim to all of that cash. But if regularly you take that cash and you pay out to another shell company, right? If this company gets sued, they have no claim to the cash in the shell company, because we have this basically that limited liability veil that exists between shareholders, right, and companies, and therefore they can't go after the holdco because you've taken out the cash and you've basically placed it. What you've done is you've creditor proofed, right? So high level, if you don't have things to invest in, you don't leave cash in a company. It's just a sitting duck basically, right? Because if you get sued, you get into trouble, you lose it all, right? Whereas if you move it out, you pay it out to your shareholders, right? Or basically you pay it out and you hold it in another holding company. This company goes down, all that accumulated wealth is safe, right? Because it doesn't matter. This company went bankrupt, this one's still safe because it's in the holding or it's in the pockets of the shareholders, and your creditors can't bypass and go to your shareholders and take their money, right? So in that case, you're still safe, right? But if you're just accumulating it, you're running the risk you get sued and you lose it all those years of wealth that you've accumulated. But again, tax strategy, this is outside of the veil of this course, but I do still like to share it. So pros and cons of the residual dividend policy. Advantages is it minimizes new stock issuances, right? Because you accurately predict how much retained earnings you're going to need. Therefore, you don't really have to issue more shares, right? Because you have enough retained earnings to finance your company. Disadvantages is it results in unstable dividends and sends conflicting signals, increased risk, and doesn't appeal to any specific clientele, right? And the conclusion is you have to consider your residual policy when setting a target payout, but don't follow rigidly. Basically, you don't do this every single year. You do it for a 5-year period, and then you stick to that so that your dividends don't change over that 5-year period. So the residual distribution model, in practice, firms should use the residual policy to help set their long-run target distribution ratios, but not as a guide to the distributions in any one year. So companies often use financial forecasting models in conjunction with residual distribution models to come up with what the perfect distribution model is for what they want to do for returns and what shareholders they want to attract, and they try to find a dividend pattern over the forecast period to ensure sufficient equity is to support the capital budget without being forced to sell new common stock. Remember, if you issue like $100 million in shares, you only get 85% of that because there's flotation costs of 15% that you have to pay the underwriter, right? Sure, you may sell $100 million worth of shares, you only get to keep 85 because there's all the flotation costs and there's all the expense associated with issuing equity. It's far cheaper to retain enough retain enough net income than it is when you have shortfalls to actually have to go and issue more equity because you're only getting, say, a percentage of those proceeds because you're paying out so much in flotation costs to the people that issue the dividends for you, right? And then regular dividends versus or regular dividend plus extras policy. These are interesting too. Some companies will just keep a very low dividend because they're freaked out that they're ever going to have to cut their dividends and they don't want their stock price to go on a Canada's Wonderland worthy drop, basically, right? And they don't want their stock price to tank. So they set the bar super low because they know they can hit it, right? But the problem is when you set the bar super low, you end up doing what I said not to do and you accumulate a whole bunch of cash, usually too much cash, right? So what these companies do is when they end up accumulating too much cash, they pay out a special dividend. And that special dividend, everyone knows it's a one-time deal. It's not going to happen again. It's just a special dividend. You get this nice big payout, right? And it happens one time. There's no signaling effects. The shareholders know it's one time. Your stock price isn't going to tank. Your stock price isn't going to increase either, right? Because there's no promise of future dividends for a one-time payout, right? So the companies will set low targets so that they don't have to deal with their stock price going all over the place and them freaking out their shareholders. And then when they accumulate too much capital, they just pay a special dividend and then they avoid any signaling issues that would come with that, right? And they make sure they always have enough, equity built up within the company that they don't have to issue more equity, right? So this is another good way to do it to avoid signaling issues and make sure you have enough equity financing. So another important concept, procedures for cash distributions. The actual procedures used to make cash distributions are discussed in this section. Basically what you have to do to actually issue a dividend from a corporation, okay? Dividends are normally paid quarterly, but here are your important dates. You have the declaration date, right? And say this is November 12th, 2021. Just gonna flip to make sure I get this right. Okay, perfect. So you have November 12th, 2021. This is when the board declares a quarterly dividend, okay? Say it's 50 cents per share, whatnot, to holders of record as of December 8th, 2021, and it's gonna be payable on January 4th. Okay, what does this mean? We know that, high level, corporations do not have to pay dividends, right? This is what makes equity lower risk than debt, because dividends or debt, you have to pay interest, but technically corporations don't have to pay dividends and shareholders can't sue a corporation and force it to pay dividends, okay? So only when a dividend is declared by the board of directors is that dividend legally payable, okay? Anytime before that, it doesn't matter if you paid dividends the last 150 years. If you have not declared a dividend, you're not legally liable to pay it to your shareholders. But the second the board declares a dividend, it is now payable to shareholders and it is legally required, okay? So that is your first date, the date that the board declares the dividend. We'll say in this case is November 12th, okay? Then we have the date that the dividend goes with the stock, okay? So here's the thing. From November 12th of when the board basically declares the dividend to we call it the cumulative dividend date, basically, right? This is between November 12th and December 6th. If you buy this stock between November 12th and December 6th, you will get that dividend, okay? It doesn't matter if you didn't own the stock, right, as of the declaration date. As long as you buy this stock by December 6th, when the dividend payout comes, you will receive a dividend, okay? However, we have the ex-dividend date, okay? This is the date date that the dividend rights leave the stock, okay? If you buy the stock on December 7th, you don't get the dividend. It doesn't matter that, on January 4th, you are an owner of that stock. You did not own the stock as of at least December 6th. You bought it on December 7th. On December 7th, the dividend rights left the stock. You have no right to that dividend, okay? So that's the day that the rights basically leave the stock for the dividend. And then you have the holder of record date, okay? So in the holder of record date, they basically go through and they take all the holders of record, every single person, the potentially millions of different stockholders. They generate an entire list, right? As of everyone that held the stock as of that date, right? They give themselves a little 2-day buffer to avoid any issuance or issues of like, oh, did you buy it before the end of the day or anything like that. So they give a little 2-day buffer, and then they go the holder of record date. They generate a list of everyone who held the stock basically as of December 6th, right? And then they pay out all of the dividends to all of those people. This is a huge process, okay? That's why it takes a month. The company has to go through basically the SEC or whatnot. They have to figure out every single institution, person that holds one of their stocks, get all of their bank info or their, investor info, right? And they have to basically individually to every single person calculate the amount of dividends they have to pay to them and pay out the dividends to those people. It's a massive undertaking, right? That's why it gets declared November 12th, but it doesn't get paid until like January 4th, which is, just under 2 months later. It's because it's a lot of work, right? And that's also why we have basically a 2-day buffer from when, the dividend rights leave the stock versus when, we assemble the list of people. And then we have another month to basically figure that out before the dividends are actually paid, okay? But very high level, the ex-dividend date, and this is what you need to know, it's the date that the rights of the dividend leave the stock, right? So if you buy the stock as of that date, you do not get dividends. So here it goes. Monday, December 6th. If you buy the stock that day, you get the dividend, okay? If you buy the stock December 7th, you've bought the stock without the rights, okay? So the person that you bought the stock from, the person that owned the stock, say I own this stock December 6th, okay? December 7th comes around, I sell the stock, okay? I'm no longer the dividend holder or the stockholder. I'm still going to get that dividend because as of the end of the day on December 6th, I held the stock and therefore I retained the rights to that stock. The rights stayed with me. They left the stock and they went to me. I sold the stock the next day. That person doesn't get the dividend, right? And then they assemble basically the list of stockholders and then they issue. I will be on that list because I owned it this day, but then I sold it this day, but it doesn't matter because I owned the stock as of this day. I hope this makes sense because this is a more important but sometimes confusing one. And I feel like I beat it to death a little bit, but I think we should be good. So stock repurchases, procedures. Repurchases say buying own stock back from shareholders. There's a lot of reasons for repurchases. So it's as an alternative to issuing a dividend, okay? It's to dispose of one-time cash from, say, an asset sale. You have a big cash influx. Let's buy back some of our equity, right? We'll reduce the number of shares we have outstanding. And we can also adjust our capital structure as well, right? Make a large capital structure change to restrain managers from wasting cash as well. Managers act differently when they have a lot of cash, right? Maybe they go off on some kind of conference or whatnot, right? How tied is that conference to actual generation of corporate value? We may never know, right? But when there's not a lot of cash in the company, they don't have those luxuries. They're under a lot more scrutiny, right? And therefore, they're not going to be as frivolous with how they spend their cash, right? They're going to only spend it on core operations, and they're not going to spend it on extra things that are just perks, right? They may, use buybacks to as a way of signaling, right? Or to offset the dilution due to employee stock options. A great example of this is WestJet. WestJet has a legendary employee stock option program. Basically, I'm pretty sure almost, unless they opt out, but I'm pretty sure almost every single WestJet employee is an owner in WestJet, right? The problem for the shareholders that aren't employees in WestJet is every single year as a part of compensation, WestJet issues a whole bunch of shares to their employees, which then, right, it dilutes the holdings of their other stockholders. So therefore, if you want to basically protect against that dilution, you'd buy back a portion of the equity to protect against that, okay? To reduce the number of shares outstanding. So there are three ways to repurchase shares. You can buy back shares on the open market. You can make a tender offer, and you can basically say, hey, here's the price I'm willing to buy back shares at. Anyone can take the option, right? Or you can purchase a block of shares from one large holder on a negotiated basis. So say a pension fund, right? Or institutional investors, ETFs like Vanguard that buy huge bundles of shares. You may negotiate with that specific investor that you buy back from them specifically, so you don't have to buy back shares from, say, everyone broadly. You don't have to put a tender offer. If there's enough supply in the market, you can just buy leftover stock in the market, right? But if that isn't the case, you might have to negotiate to buy from, say, one large investor. So patterns of cash distributions for U.S. listed companies. The ratio of cash distribution relative to net income was about, say, 27% until the early 2000s. It has dramatically increased since then. So repurchases have exceeded dividends since 1998, okay? I hate to date myself, but that's the year I was born. So in the year 1998, that is when basically everyone liked repurchases. Funny, I'm a tax guy. The year I was born, everyone decided to start, going after capital gains. Coincidence? Who knows, right? But basically, yes. That is the year people realized it's a lot more tax effective when companies will do basically repurchases of shares. Since 1998, companies have basically favored stock repurchases over dividends. And on the open market in 2017, the average dividend yield for a company was about 1.84%, but the average repurchase yield was 2.28%. It was higher because it's done more, right? And it's done in higher volumes as well. Because investors prefer it, this actually supports the tax preference theory, right? Companies are specifically pursuing this because they know they can put more money in their shareholders' pockets, and they know that that's actually going to increase the valuation of their firm, right? Because shareholders are getting more for the same cash distribution. I'll show you how. TSX listed stocks show similar trends in increasing cash distributions. From 2000 to 2019, they grew 40% faster than earnings. So the effects of stock repurchases. All right, these next slides are not fun. And I don't find they tell you a whole lot. So instead of doing that, I am just going to do this on the board. And I will basically show you the difference of what happens when a company issues say a common stock, or basically issues a dividend, versus what happens if they repurchase the shares. So maybe to help you out, I'll stop sharing my screen for the purposes of this PowerPoint, and then I'll reshare. Okay. So let's work through this. Get rid of all my great tax. Oh, I forgot. This is. I need a better way to erase this because it doesn't come off very nice with that. Oh, that's even worse. There used to be a dry erase, like kind of wash, but I think they took it out of here. I don't know. Maybe a physical plant wasn't happy that I'm doing part of the job right now. But anyways, wow, that really is not coming off. I can't tell if it's just because the board's so clean, but yeah, I'll have to do. Okay. And you can see, perfect. So, let's start here. So, assuming no debt, right? I'm gonna make that assumption very clear because debt tends to throw things off a little. So, we have prior to your repurchase of shares to repurchase. Okay, and then we have after your repurchase. Okay. So first, we're going to look at what the impact on the company is of a repurchase of shares, and then we're going to look at what the difference would be if that same company had basically issued a dividend. Okay. So in this case, we're assuming no debt. So the value of the assets is the value of the equity. Okay, and that's why we're doing this. So assets in this case, will be 40 mil, okay? Therefore, because we have no debt, our equity will also be 40 mil, okay? And then, after, right, and in this case, we're gonna have shares, and we're gonna have 2 million shares outstanding. So we're gonna go divided by 2 million, okay? So we're gonna have basically a price per share of $20, okay? So in this case, basically the idea is we have $5 million in cash kicking around that we don't really need, and we don't really have investment opportunities, right? So what we're gonna do is we're gonna pay out that 5 million in cash, right? And we're gonna look at what that impact will be on the stock price. But we're not gonna pay out dividends. What we're gonna do is we're gonna repurchase shares instead. And we're gonna look at what that impact of repurchases, okay? So if we pay out $5 million in cash, what happens is our assets drop to 35 million, right? Which is 40 million minus 5 million, okay? And therefore, because we have no debt, our equity will also drop to 35 million, right? Because what we're doing is we're buying back shares, we're basically wiping it out, right? We're crediting cash, we're debiting shares, it wipes out, they're both worth less, right? Now, here's the deal. We are basically buying back 12.5%, okay? And that is calculated, it looks like it's the 5 million divided by the 40 million valuation of the company. So we're basically buying back 12.5% of the company, right? So in this case, right, if we're buying 12.5% back, that basically means 12.5% is 1/8, and 1/8 of 2 million is 250,000, okay? So therefore, out of the 2 million, now we only have 1.75 million left of shares, right? And therefore, when we do the math, the price, funny enough, is still 20 bucks per share, okay? So yes, we bought back 250,000 shares, which is 12.5%, right? But even though our company is still worth 35 million less, or sorry, $5 million less, our number of shares goes down proportionately and our stock price stays the exact same, right? So prior to this repurchase, this is what your holdings would look like if you held 8 shares, okay? So your holdings, if you had 8 shares, and this is from the perspective of, say, a shareholder. So your ownership would be, so holdings at 8 shares. You would have 8 shares multiplied by $20 per share, right? So basically, you would be worth 160 bucks, or at least your holdings in this company would be worth 160 bucks, right? Now, after, right, the buyback occurs, they buy back 1/8 of the shares. I have 8 shares, basically they buy back 1 share from me, okay? So, after the buyback, this is what your holdings will be. You would basically have 7 shares now, because they buy back 1 share from you, 7 shares. And we know the price is the same, so it's going to be 7 shares times 20 bucks, basically. So my holdings are going to be worth 140 bucks, but they bought back 1 share from me, right? And they bought back that 1 share at 20 bucks. So my cash is going to be that 1 share that they bought back, multiplied by the $20 they bought it back at, because my share price did not change. Therefore, I got 20 bucks in cash. Therefore, I'm worth the exact same, but, right, now I hold 7 shares instead, and now I have $140 in shares and basically 20 bucks in cash, whereas before, I was still worth 160, right, but it was all shares. So the firm was able to effectively, without changing the price of the share, transfer me $20 by basically just buying back a single share from me. But my value, right, still remained the same because, yes, my numerator changed, but my denominator changed proportionally, which kept my share price the exact same, right? This is kind of the science behind why, you know, you're still worth the same, but they're able to get money to you, basically, right? The best part is, though, this 20 bucks in cash that you get, that is taxed at a capital gain. Okay? And this is important. So, by transferring me this $20 and not doing it as a dividend, but instead buying back 1 share from me, I only pay capital gains. So say my marginal tax rate is 50%, I'm only going to pay basically 50% of that, right? So, and I don't know what my cost base is, but for simplicity, say I only actually pay tax on $10 worth of it, right? And then, so therefore my tax payable would be $5, right? Whereas say my marginal tax rate was 50% and this was a dividend, I would pay tax on the whole thing, so therefore my tax would actually be double, right? Okay, now, there's another benefit though. So in the future, oh no, I can't use that. So in the future, when I'm calculating my EPS, what's going to end up happening is basically my EPS is going to equal, right? My net income in the future divided by 1.75 million shares. Whereas, that is instead of my net income divided by 2 million worth of shares, right? So, therefore, my cash flow per share will increase more rapidly as a result of the same increase in net income. Okay? So therefore, my price would also go up at a faster rate as well. So what I'm doing is I'm protecting against dilution, and now when at the same net income, I'm going to have a higher EPS, which makes my share look better. It gives me more cash flow per share, right? Basically overall higher EPS per share. So it's a double-sided effect. My shareholders get this cash, and they get it at a capital gain instead of paying dividend rates on it, right? And I protect against dilution, and my share price is likely to go up faster in the future, right? It's likely to fluctuate more. Okay, now let's look at the difference between a dividend and a share repurchase. Okay, do I have enough space? Yeah, just enough. Okay, so here is a dividend. Okay, and then here is your share repurchase. We're going to use the exact same example, but this is going to be basically after we've executed the actual payment, okay? So, in this case, we're going to have assets 35M, therefore equity 35M, because we have no debt. And we're going to have shares, right? So under dividends, we don't buy back any shares. Therefore, we'd still have $2 million worth of shares outstanding, even though the firm's worth less now because we paid out $5 million worth of cash, right? So in this case, our new share price is going to be $17.50 per share, okay? This is the price. Now, your holdings would look like this. You would still hold 8 shares because they didn't buy back a share from you, okay? And those shares would be at $17.50, okay? And therefore, it would have a total value of $140, just like over there, right? And you would get a cash dividend of $20. $20. But that $20 is going to be taxed fully. It's not going to be taxed at a capital gain like we were over here, okay? So actually, if I can do this, I can just compare this across from here to here. So that's taxed at a capital gain, where this is just taxed, this is just taxed fully. So, under both circumstances, you are worth the exact same, okay? Whether you pay a repurchase, or you repurchase shares, or whether you pay a dividend, okay? But under the dividend, what happens is your stock price drops, right, to $17.50, because we take $5 million out of the company, but we still leave the shares outstanding at $2 million, right? So, and you still have 8 shares. So those 8 shares, now multiplied by $17.50, are worth $140, right? But you get that cash dividend at $20, but you're paying pretty much double the tax on that exact same cash distribution, right? So in this case, tax at the higher rate. This is generally why shareholders prefer the repurchase. What ends up happening with the stock price is it looks like this. When you have repurchases and you have dividends, your stock price will look like this, okay? Whereas, if you pay out dividends, instead of repurchasing shares, your stock price is going to look like this. Okay? And what this means, oops, I pinched my paper. Every time, so say this here is D1, D2, D3, dividend 1, 2, and 3, or sorry, I should call R1, R2, R3, because it's actually repurchase. R1, R2, and R3, right? Why do you make the repurchase? No impact on your price, right? Whereas under here, this is D1, this is D2, this is D3 for my dividends, right? Every time I pay a dividend, it drops my stock price as I showed here, right? So we talked about shareholders preferring companies, right, that basically are able to hold steady returns. When you do repurchases instead of dividends, your stock price doesn't take a hit and it's less volatile, right? So that's another added benefit of going with the repurchase route. There's the tax benefits. For instance, you know, in this case, right, say, again, you're at the marginal rate of 50%, right? Which is one of the top brackets on this $20, but it's a taxable capital gain, so you only pay tax on half. In this case, you would likely only pay $5 worth of tax, right? Worth of tax. So after tax, you would have about $15, right? Whereas in this case, you would pay 50%, right? So your marginal tax rate, but you'd pay them the whole entire amount, right? So in this case, right, you would multiply your marginal tax rate by the entire $20. So say 50% is your rate, multiplied by the $20, right? So therefore, you would pay $10 in tax, right? And you would have tax paid, and then after tax cash flows would be $10. Would be $10. So in this case, you keep $15 and you pay $5 in tax, whereas in this case, you keep $10 and you pay $10 in tax, right? So you're effectively keeping 50% more money in the case for repurchase. Because your shareholders are keeping more money in their pocket, the firm is actually worth more to them, right? Because shareholders don't care about gross, okay? When it comes to gross income, whatever. Shareholders care about net, how much money they actually get to keep, right? They care about the money that actually increases their valuation. Therefore, when you do a repurchase, and therefore they get to keep more money in their pocket, your company is worth more to them and they require a lesser return because of it. Whereas you keep paying dividends on them and you keep forcing them to pay it at the full tax rate, they, you know, yes, you're paying a whole bunch of net income, but you're not paying it at a tax favorable rate. They don't get to keep it, right? So it's worth less to them. Okay, so I'll reshare my screen. Tap screen and share. Good. All right, so perfect. Okay, so the effects of stock repurchases. This is everything we just did, but I did it on the board because it's a lot less confusing. After the repurchase, we just covered, and then does not change. Yep, we covered this. Doesn't change the stock price, and then we also covered these graphs, right, of how a repurchase basically keeps the price steady, whereas a dividends tend to tank the price, and the price drops and goes up, drops, goes up because the company's worth less, but it's the same amount of shares outstanding. Pros and cons of dividend repurchases, right? Advantages of repurchases. Stockholders can usually choose whether they want to be a part of the repurchase or not, right? So they can basically, if there's a tender offer, they can choose to take the offer, right? Which is good. Now, here's the thing, right? If a repurchase occurs and there are now less dividends on the market, right? But you, relative to the other shareholders, keep your shares, you are now actually holding a slightly bigger proportion of the company, right? Which works out for you. So in that case, even if you decide not to take advantage of the repurchase, you still benefit because you'll get a slight capital gain because you own more of the company in that case than you did before. Whereas if everyone equally repurchases, then everyone keeps the exact same, right? Whereas if the repurchase is specifically targeted at one person sells, basically the company buys back the stock from one massive institutional investor. Because that stock's completely off the market, everyone else that holds stocks now holds a bigger proportion of the company, and therefore their stocks are worth more. Okay. Using them helps to avoid setting a high dividend that cannot be maintained, right? Repurchase stock can be used in takeovers or resold to raise cash as needed. It basically creates equity capacity, right? Now that you basically rebought a whole bunch of stock, you can now go and issue new stock if you want to, and you don't have to worry about diluting the shares too much. Income received is capital gains rather than the higher tax dividends, which is also an awesome benefit, and stockholders may take it as a positive signal. Management thinks stock is undervalued, right? At the end of the day, in most cases, management would not go into the market and buy back their own stock if they thought it was overvalued. They would only do that if they thought the stock was undervalued, right? So what it does is it gives the signals to the stockholders that these stocks are undervalued, right? Therefore, it's a positive signal and it'll trigger them to go and buy the stock, right? It shows that management is confident in the stock price. Disadvantages of repurchases. They could be basically viewed as a negative signal, aka the firm has poor investment opportunities, right? So therefore they're just buying back shares, they have nothing to invest in. CRA could impose penalties if repurchases were primarily to avoid taxes on dividends. That does happen, right? So if the company has a whole bunch of money and they just decide that we're going to do a repurchase purely because it's more tax beneficial to our shareholders than basically issuing a dividend, they Canada Revenue Agency may get a little mad about that because they get 50% of the revenue that they should have gotten, right? Whereas if, there's a big sale of an asset, they just all of a sudden have a whole bunch of extra cash and they want to change their capital structure, that's totally acceptable, right? Because you're doing it because there's finance purposes behind it, right? And you're doing it to change your capital structure and, change the way your firm's financed, right? But if you're just doing it so that your shareholders pay less tax, yeah, the CRA may knock on your door, send you a little note. So selling stockholders may not be well informed and hence will be treated unfairly, right? And then the firm may have to bid up the price to complete the repurchase, thus paying too much, right? So sometimes you can try to do a repurchase, but if everyone just loves your stock and does not want to sell the stock to you, you may have to buy back at a premium, right? So say no one's buying back the stock from me at $20, I might have to keep bidding like 25. No one's selling 30. Great. Now I'm paying 50% more for my own stock, right? That doesn't make any sense. So, sometimes if no one wants to sell, don't do a repurchase because you're just going to end up overpaying for your own stock. Repurchases have tax advantages over dividends, while dividends are more dependable and are better suited for those who need the steady source of income. Companies can avoid signaling effects by setting a low regular cash dividend and then using repurchases to distribute the excess, just like people do with the special dividend payouts. You can do the same with just a special repurchase, right? And repurchases are useful when making a change in capital structure, distributing cash from a one-time event, or obtaining shares for a stock option plan. So you buy back so that therefore you can issue shares to your employees for stock options to avoid dilution. Other factors influencing distributions, constraints on dividend payments, right? And then the availability and cost of alternative sources of capital as well, which may influence whether you do a distribution or not. Then we have constraints, your preferred stock restrictions. If you have dividends, we have this term called cumulative stocks, preferred shares. And when your preferred shares are cumulative, if you don't pay a dividend in year 1, you don't pay a dividend in year 2, and you don't pay a dividend in year 3, those accumulate on your preferred shares. So by the time year 3 rolls around, you owe those preferred shareholders dividends from year 1, year 2, and year 3. And the kicker is to the common shareholders cannot receive a dime in dividends until the preferred shareholders have been paid out for the year 1, year 2, and year 3 dividends that they're owed, okay? So sometimes there are preferred stock restrictions that I can't pay out dividends to my common shareholders because I have to pay off my preferred stockholders that have, dividends in arrears is what we call them, unpaid dividends, right? We may have legal constraints as well. Capital impairment restrictions, net earning restrictions, insolvency restrictions, right? You can't issue a dividend if you don't have retained earnings, basically, right? If your retained earnings is negative, you're not issuing a dividend because you have nothing left. You're basically stealing from your debt holders at that point, right? So you can't issue a dividend if you don't have retained earnings. And if you're potentially insolvent or you're very close to filing Chapter 11 bankruptcy, you can't issue a dividend. If you do, your board of directors is absolutely getting sued by the creditors, 100%, because they took capital that they should have used to pay the debt, right? And they took it away and they paid it out to the shareholder. That is illegal. So that is another restriction as to sometimes you can't pay a dividend if you're going to go bankrupt. You have to leave the capital in the company for the creditors. That's why you take it out over time so that you don't get into that position. Alternative sources of capital, cost of selling new stock, the ability to substitute debt for equity, and also control as well. So summarizing the distribution policy decisions, the distribution policy decision is made jointly with the capital structure and capital budgeting decisions. You look at your structure, you look at the budget, you multiply, what percent we're going to finance by equity by the total capital budget. We figure out how much retained earnings we have to basically keep within the company. Go net income minus what we have to retain. Therefore, that's what we can pay out, and we do it over, say, a long-term basis. The effects of asymmetric information suggest that to the extent possible, managers should avoid new common stock sales and dividend cuts because they make the dividend price volatile, and you also have to deal with flotation costs. And to set the distribution policy, managers should begin by considering the firm's future investment opportunities relative to the projected internal sources of funds. The steps in setting up the distribution policy, you usually do about 5-year forecast, set the target structure, estimate the annual equity needs, set the target payout based on the residual model, and then generally some dividend growth rate emerges, and then that's what you use to do your residual dividend model. So consistent with the life cycle theory, firms with superior investment opportunities such as young firms combined with relatively low cash flows should set lower payouts and should hence retain and reinvest their earnings, right? Because they have profitable, net NPV projects that they can invest in. Whereas firms that are mature and they begin to generate more cash flows, they tend to pay out more dividends and issue more debt to bind their cash flows to reduce agency costs, right? And then distribution decisions in practice. So financial executives believe it to be extremely important to maintain dividends rather than initiating or increasing dividend payments. Cash distribution decisions are viewed to be much less important than capital budgeting decisions, right? Your main priority should be how you're growing your firm, and therefore your main priority should be your capital budget and what projects you have available to invest in. The second is how much you end up paying out, whether it's dividends or whether you're paying out in repurchases or whether you're paying, doesn't matter. Honestly, you're going to attract a certain type of clientele. They're going to buy your shares. So just do what maximizes the value of your firm, and then you're going to attract shareholders that are attracted to your strategy. Repurchases are preferred for their flexibility over regular dividends, and taxation is not a major factor in choosing how to distribute cash. Not for you, your shareholders will care. So stock splits and stock dividends. Stock splits, the firm increases the number of shares outstanding, say 2-to-1, right? Basically, what ends up happening, you own 100 shares today, a 2-to-1 stock split occurs. Tomorrow you own 200 shares, but they're all worth half the value. That's it. There's no change, right? Everyone's shares get multiplied by 2. So your piece of the pie remains the exact same. You just have a smaller slices of the pie, but your percent ownership of the company is the exact same, right? Double the shares, half the value. That's all a stock split is. Stock dividend, it's basically a micro stock split, okay? A stock dividend isn't a true dividend, right? Say you own 100 shares, they do a 10% stock dividend. Okay, great, you get 10 more shares. The problem is, everyone else gets a 10% boost too. Your piece of the pie remains the exact same, you just have 10% more shares in the pie, but everyone else does too. So it grows, but then it gets smaller because everyone else's piece of the pie gets bigger and you have the exact same ownership. That's all it is, right? So stock split is like on a massive basis, 100 shares goes to 200 shares, but those shares that were worth $100 drop down to $50, whereas a stock dividend is like only like 10%, right? It's not like double, you know? It's much more subtle. And then splits and dividends are conceptually the same, and neither really creates any real economic value to the shareholder. Stock splits, a 2-for-1 stock split, existing shareholders receive an additional share for each share that they already own, and there will be twice as many shares outstanding, which will cut the share price in half, right? And each shareholder retains their proportionate share of ownership. Initially, the EPS and DPS will also be half their former levels, but they'll restate the previous EPS to basically show, make historical data accurate. Now, a 10% stock dividend, a shareholder will have 100 shares, receive 10. I think I've taught this lecture too many times, but basically it goes from 100 to 110. It's just a micro stock split is all it is. So, and then effect on stock prices, both stock dividends and stock splits increase the number of shares outstanding. The pie. They're basically just showing you what I was just showing you with my hands with the pie. It stays the same. Your percent ownership stays the same. You have more stock, but everyone else has more stock. So it keeps you exactly the same. You have the same percent ownership, you just have more shares. That's it. But it doesn't change your wealth because the underlying asset is worth the exact same. So you have the same percentage ownership of the same asset that's worth the exact same. So therefore, your total ownership is still worth the same. You have more shares, but it's just the same. But there is an optimal price range. Where is it? Here it is. So stock splits are useful if you want to try to keep your share within a certain price range, right? Because if you've ever looked at Google stock, it's worth about 1,700 USD to buy one stock. There's a big chunk of the market that can't afford to spend $1,700 USD on a single stock. That's not good for a company because only one small portion of the market can afford to buy their stocks, right? Usually only institutional investors or people that already have a lot of money, right? Whereas if you want to drive up your stock prices, the best thing to have is to have your stock price set between 20 and 80 bucks so that when good news comes out, everyone can afford to jump on the bandwagon, which is going to shoot your stock price up, right? Whereas good news comes out for Google, only 25% of the market, maybe 20% of the market can afford to jump in because only that percentage of the market can actually afford to buy their shares, right? So these stock splits and these stock dividends, yes, your percent ownership stays the exact same. You own more shares, but the price per share decreases proportionally, right? But it is effective because, say previously, the stock price was, I don't know, 120 bucks, we do a 30% stock dividend, and it gets that price down to like 60 bucks, or no, that was a half. Basically, it gets down to like 80 bucks, right? That's worth it for the company, right? It kind of seems like a good thing because they're issuing more stock, but really they're just managing the stock price, right? This actually happened to me. That same ETF I was telling you about, SOXX, I didn't know that they were doing a stock split one day. And I was like, wow, NVIDIA is doing so well. Meanwhile, this company did a 3-for-1 stock split on me, and the valuation of the holdings dropped by 70% on me, and I had no idea. And they hadn't issued the new shares yet, so I still had my original shares, and the value of those shares dropped by 70%. And I was like, huh? What's going on? And then I did my research and I was like, oh, they did a stock split. And then I went back on the next day and then I saw my holdings went up from like 9 to 27 or something like that, right? So my holdings tripled and then my value caught right back up. So I was like, oh, okay. I didn't lose any money. Yes, the share price tanked by basically 2/3, but then all of a sudden my number of shares I held multiplied by 3 and it ended up being the exact same amount. However, I was not aware. And I wasn't paying attention to the market, and because of that, there was a good 10 minutes where I was just sweating for no good reason. So pay attention to stock splits. They're not always a bad thing. Sometimes you'll see, huh? No, it's fine. But it was quite funny. If you went on Reddit after and all the people that were in the same boat, everyone was freaking out for a good 10 minutes, and then they realized, oh, it's just a stock split. Yes, it went down by 1/3, but we're going to get our holdings are going to go up by 3 times, and it's going to be fine. So. Great example of how a stock split personally impacted me. They exist, they happen, but it was just the firm managing their share price. The share price got way too much, and they cut it by 1/3 so that more people could afford to buy in, especially with semiconductors being so popular. They want to make sure as many people can buy in as possible to drive up that price further, so eventually they can issue more stocks. Dividend reinvestment plans. This is shareholders can automatically reinvest their dividends, right? You get the dividend, it's annoying. Now you have cash. Now you basically have to take that cash and now you have to go and buy more shares with it. When you do that, you take a hit on the commissions, right? Because you have to pay commission to go buy more shares. It's super annoying. So instead, right, you can reinvest your dividends, right? You still get taxed on them, but they get automatically reinvested and you basically pay reduced commissions, right? So it also benefits the firm because instead of taking that cash and investing in other companies, that cash is taken and buys up excess stock in the market, and therefore it actually drives up their stock price, right? So it works out good for the firm too, and it works out good for you because you pay less in commissions as well. There are two types. There are market purchase plans where a dividend reinvestment plan, it buys excess shares off the open market. And then there's also the new stock purchase plans where actually you're buying brand new stock directly from the firm. You're not buying off the open market. Everyone gets a good deal on it. So open market purchase plans, dollars are just reinvested, are turned over to the trustee who buys shares on the open market. Brokerage costs are reduced because of the volume, and thus it is a convenient, easy way to invest, and you can just forget about it. You can do this with basically a major bank if you buy enough. In dividend. And the new stock plans are different. Under these, the firm issues a new stock to dividend reinvestment plan enrollees, right? So they're not buying off the open market. It's pretty cool. You're buying stocks directly from the company you're investing in. Those stocks have never been held by any other shareholder before. They're issuing brand new equity directly to you instead of dividends, which is pretty cool. They would have paid in dividends, but you're technically buying stock off them, which is kind of interesting. It's not really a stock dividend because it's taking the place of a dividend distribution. So it's an interesting kind of area, right? But at the end of the day, it does still count. You're technically receiving a dividend and then you're buying stock with it, but instead of buying it off the open market, you're buying it directly from the company. No fees are charged because you're buying it directly from the company. You don't need a broker, right? The company is issuing directly to you. Plus the firm sells stock at a discounted rate. Everyone gets a good deal. You don't pay market rate, you pay 5% less than market, and that offsets the brokerage cost, which is nice. And then new stock plans, so optional investments, up to 150,000 or so are sometimes possible. Firms that need new equity capital use new stock plans, and firms that with no need for new equity capital just use open market purchase plans. If a firm is not going to be issuing new equity, they don't bother, selling direct to customer, right? And then most TSX listed companies have a DRIP, which is useful for investors because they'll just automatically repurchase from the market, which is nice. Here's the summary of everything we've just talked about over the last, we are super consistent at about 1 hour and 50 minutes. No matter how quick I think we're going to get through this, we're almost always at 1 hour and 50 minutes. So I'm starting to think I'm the problem. Anyways, yeah, that's the chapter. I'm going to kill the recording and then we can kind of go to a Q&A. Thank you for watching.